To discuss the ongoing troubles in Hong Kong and what this means for business and investors, we're joined by Greg Thomas from 375 Park Associates. Greg, thank you very much for joining us. It's always a pleasure to speak to you. How are you?
I'm good, Jack. How about yourself?
Greg, with trouble continuing in Hong Kong, do you see a resolution in sight, or have we gone too far now?
Hi, Jack. I think first we need to define resolution. In that, will the 5 demands be met? Probably not. Will the chief executive, Carrie Lam, step down? Probably not. Will the People's Central Government order a Tiananmen-style crackdown? Probably not, at least at this point, as the regime is just too addicted to U.S. dollars, the dollars that they get through Hong Kong's financial system. In our view, we expect the government in Beijing will most likely announce the official end to the one country, two systems framework in the coming weeks. Under this scenario, the central government would declare the arrangement a failed experiment brought on by an unequal treaty with a Western power. Not only would this approach strengthen Xi's grip on power within China, but it would leave the West with little or no options to counter, as the move would just be an assertion of Chinese sovereignty over a territory which is broadly accepted as part of China. However, this move would be met with further protests in Hong Kong and possibly the dissolution of the Legislative Council as well as the courts, and the further merger of the HKPF, the police force, and customs and the excise department with their mainland counterparts. Ultimately, at least from the context of the Chinese or the central government in Beijing, this would legitimize any moves to put an end to the protests once and for all.
Greg, as someone with deep business links in Hong Kong, what are your thoughts on the future, especially in regards to business?
Yes, I love Hong Kong and I love China, but we need to face facts. The party is over, and the future of the global economic order is most likely one where we will need to contain and deleverage our exposure to China. Ultimately, we are at war with China. This is a war of economic and political ideology, and at least at this point, China is winning. With regards to business, we have been sending 3 messages to our clients. First, the risk of doing business in China outweighs the rewards. Second, if your business model relies on government contracts, especially in defense-related sectors, then why risk future cash flows by pursuing a China strategy? And third, if your business model relies on Chinese tourists, then you need to deleverage immediately, as the central government can turn the spigot off at any time. As such, we believe it's prudent for firms to start rethinking their supply chains and go-to-market strategies as it pertains to China and Hong Kong, with strong consideration of de-risking before it is too late.
Finally, Greg, what is your advice for investors and others who have a stake in Hong Kong?
Well, for the people of Hong Kong, I think we must admit that while Hong Kong today has been granted special consideration by the central government, these privileges can be revoked at any time. This is the sad irony of life in the People's Republic, as the people are not free. While my heart is with the people of Hong Kong, I must resign myself to the fact that Hong Kong cannot defend itself. And as such, the illusion of freedom, the rule of law, once touted by the city's authorities, is fleeting and will most likely be extinguished in the coming weeks. For investors, now is not the time, to be exposed to the Hong Kong market, as even having US dollar denominated investments in Hong Kong represents an irresponsible level of risk. Furthermore, we believe capital markets have significantly mispriced the risk and that the market itself is being manipulated. This is evident when one looks at the data. For example, the Hang Seng continues to trade above its 52-week lows and is up 3.7% this month alone, even though the political situation is impacting businesses on the ground. Also, there is mounting evidence that confidence in the Hong Kong dollar, long considered a haven, is crumbling. While the composition of foreign currency reserves kept by the city's central bank, the Hong Kong Monetary Authority, is reported every March, several analysts believe the HKMA has been using their USD reserves to keep the Hong Kong dollar, from going into a free fall. The prospect of eroding USD reserves is significant, as the Hong Kong dollar is pegged to the greenback, and pressure on the Hong Kong dollar can be seen in pricing of forward contracts on the currency, which in recent weeks have consistently traded outside the range of the peg. While the HKD is poised to drop significantly, the fact it hasn't is an indication of intervention by the HKMA. Another indication of intervention is the recent surge in the HIBOR. This is the Hong Kong interbank overnight rate, which has made it harder for investors to completely abandon the HKD. However, the jump in the HIBOR rate could be an indication that the HKMA is running out of resources needed to fight the shorts. And this is indicated by 16% and 12% drops in other reserve assets and other foreign currency assets, respectively, in August. It's also worth noting that money supply in Hong Kong as a percentage of the total economy has surged in recent years. So much so that we believe the question of the structure of economy is valid. Based on a snapshot of 10 economies, the average M3 to GDP was 1.7 times. However, Hong Kong has an M3 to GDP of roughly 5.3 times. And if we exclude both China, which has a 2x, and Hong Kong from the average, the rate falls by 42% to 1.2 times. Given the average includes the impacts of quantitative easing undertaken by the US and the European Central Bank, it would appear authorities in Hong Kong and China are manipulating the money supply, reported GDP, or both. In fact, a 2014 report in the South China Morning Post noted that money laundering was a huge problem in Hong Kong. And we believe the issue has only grown since then, especially as the Central People's Government in Beijing has cracked down on flows of money into and out of the gambling dens in Macau. Why has this been allowed to happen? While Hong Kong's importance to the economy of China has diminished over time, it remains the only viable locale where party officials can cheaply move money offshore. However, this is about to change. Our sources in Hong Kong and on the Chinese mainland indicate that those closely aligned to the ruling clique have either converted most of their liquid assets into US dollar or moved them out of Hong Kong altogether. This should not be a groundbreaking revelation, as multiple news outlets have reported on capital flight in recent months. And even the chief executive has warned of the coming economic tsunami. As such, investors need to take a step back and question whether their exposure to Hong Kong is warranted. While it's probably too late to do anything about illiquid assets such as real estate and companies, there's a narrow window of opportunity to either convert Hong Kong dollar assets into US dollar or to move them offshore altogether. As for illiquid assets, we believe it's too late. In fact, Bloomberg reported last week that Singapore's Temasek has placed on hold plans to exit its $3 billion stake in the Hong Kong-based A.S. Watson Group. The planned sale fell through as Temasek could not find a buyer willing to accept its valuation. And this is while sources indicated that Temasek had fielded interest from multiple CCP-affiliated companies, including Alibaba and Tencent. The fact that neither pursued the acquisition is a clear indication that those groups aligned with the CCP now believe it is not the time to invest in Hong Kong. Given the ongoing protests, the coming 70th anniversary of the People's Republic on the 1st of October, it is inevitable that something will happen sooner rather than later.
Greg, thanks so much for speaking with us. It's always a pleasure to speak to you. Hopefully we'll stay in touch and speak again soon.
Thank you, Jack.
Well, a big thank you to Greg, and thank you for watching. If you enjoyed this interview and would like to find out more, be sure to head over to dukascopy.tv.